Hello, and welcome to the Equity Method webcast. In this presentation, we explain why the IASB added this project to its research agenda, the project objective, and how the IASB is approaching the project. We will explain the IASB's tentative decisions so far, that is, changes or clarifications it will propose to IAS 28, investments in associates and joint ventures, and the project's next steps. Let me start by explaining what the equity method is and when it is applied. IAS 28 and IFRS 11 joint arrangements require the application of the equity method of accounting when an investor has investments in associates and joint ventures in its consolidated financial statements. IAS 27, separate financial statements, also permits the equity method in an investor's separate financial statements for its investment in subsidiaries, associates, and joint ventures. Simply, when an investor obtains significant influence or joint control, it recognizes any difference between the cost of the investment and its share in the net fair value of the investee's identifiable assets and liabilities, either as goodwill or as a gain from a bargain purchase. Thereafter, the investor's share of the investee's profit and loss is recognized in profit or loss, and the investor's share of the investee's other comprehensive income is recognized in other comprehensive income. The investor also adjusts the carrying amount of the investment for distributions received from the investee. This slide explains why the IASB is undertaking a project on the equity method of accounting. The equity method project responds to feedback on the 2015 agenda consultation. That is, a number of queries on the application of the equity method have been raised with the IFRS Interpretations Committee. At that time, the IASB thought that it would be able to consider this topic most effectively and efficiently after it had assessed feedback from the post-implementation review of IFRS 11. The IASB, therefore, added the project to its research pipeline following the 2015 agenda consultation. The research pipeline includes future research projects, which the IASB will start normally before the next agenda consultation. Between September 2019 and April 2020, the IASB began the post-implementation review of IFRS 11 and approved matters to be examined in a request for information. Because the request for information had not examined matters related to the application of the equity method, in October 2020, the IASB moved the equity method project from the research pipeline to its research program. In doing so, the IASB set the project objective and decided on an approach to the project. The project objective was to assess whether application questions with the equity method, as set out in IAS 28, can be addressed identifying and explaining principles in IAS 28. To achieve this objective, the IASB decided on the following approach. First, to combine various input sources, for example, questions to the IFRS Interpretations Committee, and derive a possible list of application questions. As it was not possible to answer all the questions, the IASB applied a selection process considering specific criteria to derive the question in the project scope. You can find the list of application questions in the project scope on our website. Secondly, the principles that underlie the requirements in IAS 28 were identified and explained. The principles aim to provide the IASB with a toolbox to help develop answers to application questions. Finally, and ongoing, the IASB developed answers to application questions in scope of the project. The IASB decided that to simplify its discussions, it would answer application questions applying the equity method to investments in associates first. It will consider if there are any implications in applying tentative decisions to investments other than those in associates, for example, joint ventures, at a future date. The IASB has completed the discussion and taken tentative decisions on all but 2 application questions. It will discuss the 2 remaining questions. One question is to clarify when an investor should assess if its investment is impaired, and one question on how to measure an investment when the consideration includes contingent payments. Now we pass over to my colleague Mostafa Muit. Mostafa, would you like to explain the IASB's tentative decisions, where we are now in the project, and the next steps?
Yes, Filippo, my pleasure. So let's dive straight into the IASB's tentative decisions. Starting with the first category on investor ownership changes while retaining significant influence, in answering this question, the IASB divided the discussions to include, first, how an investor measures the cost of an investment on obtaining significant influence. This is because IAS 28 does not define costs. And second, how an investor would apply any approach to different circumstances, for example, on additional purchase, partial disposal, and other changes. In March 2023, the IASB completed its discussions and plans to propose the following. First, an investor would measure the cost of an investment on obtaining significant influence at the fair value of the consideration transferred, including the fair value of any previously held interest in the associate. Second, an investor purchasing an additional interest while retaining significant influence would recognize any difference between the cost of the additional interest and its additional share in the net fair value of the associate's identifiable assets and liabilities, either as goodwill or as a gain from a bargain purchase. Third, in a partial disposal, an investor would measure the portion of the investment to be derecognized as a proportion of the carrying amounts of the investments at the date of the disposal. For example, if an investor that has immediately before the date of the disposal a 30% ownership interest in an associate and sells a 10% of that interest, the investor measures the portion to be derecognized as 1/3 of the carrying amounts of the investments at the date of the disposal. And finally, when the investor's ownership increases or decreases, for example, when an associate issues or redeems shares, an investor would recognize that change as a purchase of an additional interest or as a partial disposal. Turning to the second category, and in discussing whether an investor that has reduced its interest in an associate to nil is required to catch up unrecognized losses if it purchases an additional interest in the associate, the IASB plans to propose that an investor that has stopped recognizing its share of an associate losses in accordance with paragraph 38 to 39 of IAS 28 would not recognize any unrecognized losses on purchasing an additional interest in the associates. Turning to the third category on transactions between an investor and its equity accounted investments, the IASB discussed 4 alternatives to answer the application questions in this category. Between September 2022 and March 2023, the IASB members and staff discussed this with consultative groups and stakeholders, specifically users. The IASB then discussed at length the alternatives and the feedback. The IASB plans to propose the alternative that will no longer require an investor to restrict gains or losses on all transactions with its equity accounted investments, i.e., to eliminate the elimination interest requirements. Lastly, regarding the deferred taxes category, the IASB plans to propose that an investor would account for and include in the carrying amount of its investment in an associate a deferred tax asset or liability arising from recognizing its share of the associate's net identifiable assets and liabilities at fair value. At its April 2023 meeting, and because the IASB has concluded discussions on significant categories of the application questions, it decided to move the project to its standard setting work plan. The IASB also decided to work towards publishing an exposure draft at the next due process step. It was considered that the proposals will be best explained when set out as proposed requirements in the accounting standard, particularly as the IASB is not putting forward alternative solutions to application questions. In making these decisions, the project's objective was updated to reflect the progress made. The updated objective is now to develop answers to application questions about the equity method as set out in IAS 28 using the principles derived from IAS 28 where possible. At future meetings, the staff plan to ask the IASB to discuss remaining application questions within the scope of the project and also to discuss any implications of applying its tentative decisions to investments other than associate entities. Once the IASB has made tentative decisions on these aspects, the staff also plan to ask the IASB to discuss possible improvements for the disclosure requirements to accompany its tentative decisions, and to discuss transition requirements for the proposals to revise IAS 28. Last but not least, we encourage you to visit the IFRS Foundation's webpage where you can find more details about the project. Thank you for listening to this webcast and for your interest in this project.